Good evening, Garage Gang. It's Friday night, and it's me, your man, Avatar John. I've got the wheel tonight. It's hot, and I'm going to be your guide through today. Because if you're not locked in right now, you're already behind, and the market already took your lunch money. Because right now, the market is doing that thing where it smiles at you while it quietly rearranges the furniture and then acts shocked when you trip over it. Bitcoin is out here acting like a street fighter. It smacks the level, snaps back, hunts stops like it's a hobby. Ethereum goes quiet because that's what it does before whales move size in the shadows. Solana's got that I'm not asking permission energy, ripping while institutions chew up weak hands like sunflower seeds. And the stablecoins, they don't even look at spot. They go straight to leverage, like, hey buddy, want to ruin your weekend? Supply is tightening, pressure is building, and most people still think this is chop. No, sweetheart, this is the calm before somebody gets launched through a windshield. And if you're wondering why it feels weird, because this market isn't thinking, it's calculating. It's setting traps, baiting entries, and punishing emotions like it gets paid per panic attack. Now tonight, we're doing this the garage way. Fast, clean, and real. No bedtime stories, no therapy session, no, well, actually. Here's what's on the board. Japan tightens and the yen carry trade starts sweating. Options pinning and thin liquidity turn price into a puppet show. Office CRE refinance walls are loading a forced seller cannon for 2025. Auto credit stress and repo pipelines are building a confession trade. USD dominance is crushing EM, while people pretend it's strength. Crypto liquidity is rotating into memes and virality like it's a siphon. Public weakness, private accumulation. Same movie, different actors. And yes, AI is still in beast mode. Tools dropping. Workflows accelerating. The whole machine revving like nobody installed brakes. Cute, we'll use it, not worship it, but let's be honest. You didn't come here for macro poetry. You didn't come here for, well, actually explanations. You came here for triple X and the trench picks. The man's on a heater. He walked in with 53 SOL and walked out with just over 100. Like he owns the building. And it gets better. Triple X looked at Guru and said, there's still meat left on the bone. So yeah, we're going there. But first, smash the like, hit the follow, and share it with the dude who becomes a macro strategist after his third fireball and starts yelling, bro, Moondang is the ticker. It's programmed. All right, now that the garage is assembled, let's tear this thing wide open. All right, pause, because this is huge. And most people do not understand it. So I'm going to explain it like you're a degen. Because we are degenerates, just with better risk management. Here's the carry trade in plain English. A carry trade is when big money borrows in a country with cheap rates, then takes that cheap money and buys stuff that pays more somewhere else. It's basically borrow cheap, earn more, pocket the difference. And Japan has been the king of cheap money for a long time. So the world got used to doing this, borrowing yen, cheap, convert to dollars, buy US stocks, bonds, and risk assets, and rake the spread. That's why it matters. This isn't some tiny nerd trade. This is an invisible engine that helps keep global markets floating. Now here's the problem. When Japan tightens, that cheap money isn't as cheap anymore. And when the yen strengthens, the whole trade starts turning against you fast. Because now you're not just losing on the asset, you're losing on the currency move too. Let me make it painfully simple. If you borrowed yen and converted it to dollars, you need dollars to buy back yen later and repay the loan. But if the yen gets stronger, it takes more dollars to buy back the same amount of yen. So suddenly the trade becomes borrow cheap, earn more. Oh, wait, the yen just moved and ate my face. That is why carry trades unwind violently. They don't unwind slowly like, let's rebalance. They unwind like, close it now, get me out. And when big money starts slamming the exit door, everything that got pumped by that cheap money starts wobbling. That's the chain reaction. Yen strengthens, carry trade loses, positions get cut, risk assets sell, liquidity drains, volatility wakes up. Now here's the punchline. This is why FX leads. Equities can pretend, narratives can pretend, but currency moves force real decisions. And guess where the most leverage lives? Crypto. So when carry trade starts sweating, crypto gets hit first because it's open 24/7 and it's thin. Now, what do we watch? Not vibes, signals. If USD JPY starts dropping fast, that's carry unwind accelerating. If volatility wakes up while equities wobble, that's the stress transmitting. If crypto throws wicked downside moves with no headline, that's forced flow. That's why Japan matters. It's not foreign news. It's a lever on global liquidity. And when that lever moves, it can flip the whole table. All right, now we move from the sexy part, Japan yen carry trade, into the part of the market that actually breaks people. Because here's the thing, even if FX doesn't slap the market today, there are slow bombs already ticking underneath everything. And slow bombs are worse than fast bombs because they give idiots time to get confident. This is debt. This is refinancing. This is the moment where the spreadsheet shows up and says, nice story, now pay me. And remember the rule, markets don't break where everyone's watching. They break where accounting, leverage, and ego intersect, and somebody is forced to tell the truth. That's what this is, a confession zone. First bomb, office CRE. People treat office real estate like it's some boring background problem. It's not. It's a calendar. Loans come due, and when they come due, you don't get to believe your way out of it. You refinance or you sell. So imagine you bought a building when rates were low, and now the bank looks at you and says, cool, your new rate is 9 to 10%. That's not a rate hike, that's an execution. And if the building isn't full, which it isn't in a lot of places, the math doesn't work. So what happens? They extend, they pretend, they rebrand the lobby, they post a motivational quote about resilience, but the calendar doesn't care about your feelings. Eventually, the calendar shows up and the building gets marked down. And then you get forced sellers. And forced sellers don't choose to sell. They get cornered. And when that starts, it hits credit first, then spreads, then equities. And only after that does the public go, wait, why is everything bleeding? Because you're late. That's why. Second bomb, auto credit. Autos break the same way, not with drama, with repos, with auctions, with margins getting squeezed until somebody finally has to stop lying. When consumers tap out, you don't get a headline. You get delinquencies. You get repos. Those repos go to auction. If auctions are weak, dealers eat losses quietly until they can't. Then you get the moment the market is waiting for, the confession. An earnings call where the tone changes, a guidance cut, a challenging environment, an inventory adjustment, corporate language for, yeah, it's uglier than we said. And here's the key. Markets can handle bad news. Markets do not handle being surprised. So when the confession hits, the repricing is fast because it's not just the numbers. It's the trust. Now, why should a degen care? Because this isn't just real estate and cars. This is the bloodstream of the system. Office CRE stress makes lenders tighten. Auto credit stress makes lenders tighten. And when lenders tighten, liquidity dries up. And when liquidity dries up, crypto gets hit first because crypto is always the first room in the building that catches fire. Is there a money play? Yes, but it's not pray and spray. It's positioning. Office CRE is the slow squeeze setup. Watch for forced seller headlines and tightening credit. Auto credit is the confession trade. Watch for the moment the story cracks on earnings. Because once the narrative cracks, price moves like it just got uncuffed. All right, now zoom out, because while those slow bonds tick, there's another pressure system making everything worse. USD dominance crushing EM, and why an oil shock can light the whole board at once. Oil is not just gas prices. Oil is a cross-asset weapon. So when oil starts moving because supply is getting tight, it doesn't just hit one chart, it hits the whole system. Here's the chain reaction in plain English. First, inflation expectations. That just means what people think prices are going to do next. Not what the government says, not what your uncle posts on Facebook, what the big money believes. If oil rises, the market goes, uh-oh, everything costs more. Shipping, food, production. This isn't over. So expectations rise. Second, rates. Rates are the price of money. When inflation expectations rise, rates tend to rise too, because lenders go, hold on, if money is worth less tomorrow, I need a bigger return. Higher rates equals tighter financial conditions. Tighter conditions equals less easy money floating around. Third, FX. FX is just foreign exchange, currencies. And this is where people get humbled, because currencies are the scoreboard of global stress. Oil goes up, and countries that import oil get punished. They have to pay more dollars to buy energy. That weakens their currency. And countries that export oil, they get a boost. So oil moving can literally shift power between countries. Fourth, EM balance of payments. That sounds complicated, but it's simple. It's whether a country has enough money coming in to pay for what it needs going out. If you're an emerging market country and oil gets expensive, you're bleeding dollars to buy energy. So your balance gets worse. Then investors get nervous. Capital leaves. Currency drops more. That's how you get a slow motion crisis without a single big headline. Fifth, risk parity style positioning. Translation. Big funds that spread money across stocks and bonds using volatility math. They love calm. They love stable relationships. But if oil pops, inflation expectations rise, and rates jump, those relationships break. So they de-risk. And when they de-risk, it's not one trade. It's everything at once. Stocks get hit, bonds get hit, credit gets hit, then crypto gets hit, because crypto is the first thing people sell when liquidity gets tight. So when I say oil is a cross-asset weapon, I mean this. Oil can change inflation expectations, which changes rates, which moves currencies, which pressures emerging markets, which forces big funds to reduce risk across the whole board. That's why it matters. Because oil isn't just a commodity, it's a match. And when the system is already dry, one spark can light everything. All right, now we bring it back home, because everything we just talked about, Japan, rates, the dollar, oil, credit stress, that's the weather system. Crypto is the street fight that happens under that weather. And right now, the whole crypto board is running one disgusting, beautiful contradiction. Public weakness, private accumulation. Let me translate that into degen English. The public tape looks shaky. Headlines look bearish. X is screaming rug. Every 5 minutes, like panic is a subscription model. Meanwhile, behind the curtain, big money is not screaming. Big money is not tweeting. Big money is not arguing in comment sections. Big money is building inventory. And the market loves this move. Make price look weak in public, buy size in private, and by the time retail realizes what happened, the move is already halfway over, and they're buying the top like it's a tradition. That's why I keep saying price isn't moving to inform you. Price is moving to compel you to sell the bottom, compel you to chase the top, compel you to do something emotional so the machine can eat. Now here's the part that makes this whole thing even more savage. Stablecoin exchange inflows are down about 52% since August. So all these people screaming, liquidity is coming. No, liquidity is not coming. Liquidity is being rationed. That means a lot of these rebounds aren't fresh money flooding in. They're just selling pressure, taking a breather. And in a market with thin new spot ammo, moves get sharper. Upside can rip harder and downside can gap faster, because there's less cushion. So when you see public weakness and private accumulation in this environment, understand what that implies. This is a market where the crowd can get trapped both ways. Now add the second layer, and this is where the casino really starts laughing. Memes and virality aren't jokes right now. They're a liquidity siphon. People call it noise. Yeah, okay, noise that moves money is still flow. Memes are pulling attention and capital away from majors into reflex trades. Fast, thin, and violent, where the house can pull liquidity and turn your chart into a cliff in under 60 seconds. That's why it feels like BTC is doing one thing, ETH is doing nothing, Sol is ripping, and some random meme coin you've never heard of is up 300%, while your blue chip alt looks like a dead battery. That's not random. That's rotation. That's attention. That's microstructure. And it is dangerous if you think this is a fundamentals market. Now, let's address the ISO crowd, because I can hear them already. But John, ISO 20022. Listen, ISO is plumbing. It's rails. It's long-term infrastructure. Cool, but ISO does not stop a leverage flush. ISO does not defend a thin order book. ISO does not protect you from whales distributing into your feelings. ISO is a runway. Price still needs engines. And right now the engines are liquidity, leverage, and flow. That's why the smartest play in crypto right now is not I believe. It's I understand where the money is going. So here's the real state of the majors in one breath. BTC has scarcity vibes, but low reserves can mean low liquidity too. It can rip up or gap down. EFT looks confirmed, but value capture is under pressure because L2s are eating the activity. SOL has real volume, but TVL has been leaking. It's a trading venue right now, not a vault. Base is the clean traction story. Real growth, real volume, real momentum. And XRP is sitting in that perfect storm zone. Leverage flushed, order book fragile, flows off screen, retail emotional. That's the board. Now, is this a money play? Yes, but it's conditional. Crypto money plays right now are not I believe in the tech. They're I understand the flow. So the rule set is simple. Follow where liquidity is moving. Respect and validations like your life depends on it. Never confuse a pump with safety, because in this environment, one rule matters more than all the others. If BTC breaks the big line, everything speculative gets dragged behind it like a car on a tow strap. That's why the BTC support magnet matters so much. And that's why we go straight into the only thing that keeps you alive in a market like this. The next 72 hours map, what must hold, what breaks, and where the real money will strike before the crowd even knows what happened. All right, listen close. Tonight's AI headlines aren't updates. They're a line in the sand. AI isn't becoming a feature. It's becoming the operating layer of work, media, and money. And if you're not getting on board, you're not behind. You're getting replaced by people who move faster. So here's what's actually possible now in plain degen language. First, OpenAI's in-chat app directory. This is not more apps. This is ChatGPT starting to act like an operating system. Meaning, inside one conversation, you can run tools, pull data, generate content, automate steps, and ship outputs without bouncing between 10 tabs like a lost tourist. That matters because in business, distribution beats talent. And when the interface becomes the marketplace, whoever plugs in first gets the reach. So if you build anything, content, sales, ops, customer follow-up, your competitors can now move 10 times faster with tools living inside the chat. That's the shift. Next, Lumaray 3 Modify. This one is darker. It's not make fake video. It's take real video, keep the performance, and change reality around it. Change the background, change the outfit, change the props. No reshoots, sane human, new world. So one shoot turns into 100 versions. Marketing becomes infinite A/B testing. Creators stop paying for reshoots and start paying for speed. And yeah, it also means reality is easier to manipulate cleanly. That's the world we're walking into. Next, Meta SAM audio. Segment anything but for sound. You can say isolate the voice, remove the background, pull the music, and it just does it. Podcast editing gets easier. Film post gets faster. Reels get cleaner. One editor becomes a whole department. And it also means audio becomes easier to alter. So authentic becomes a brand advantage, not something you assume. Then you've got Zara using AI to redress models digitally. That's not fashion gossip. That's marketing turning industrial. They can reuse existing shoots, swap outfits, change settings, and ship new campaigns without scheduling new production days. The brands that master this will flood feeds with higher volume and better testing, while everyone else complains about creativity and loses attention. And finally, James Cameron exploring AI for VFX workflows. This is the signal people ignore at their own risk. When the highest budget operators on Earth start moving toward AI, it's because the economics demand it. Costs drop, timelines compress, quality stays high, teens ship faster. AI isn't replacing the artist. It's turning the artist into a weapon system. So here's the real talk. You need to get on board. Pick one workflow you do every day. Content, editing, lead follow-up, research, reporting, and weaponize it with AI until it feels unfair. Because your competitors are installing speed, and speed wins. All right, now that you understand what's possible, we go trench Luxor time with XXX. All right, Luxor time. Neon lights, bad decisions, and the sound of people learning what liquidity means the hard way. And I'm going to say this clean before we go any further. The trench is not investing. The trench is gambling. Honestly, most of you have better odds taking your 50 SOL and putting it on red. So if you're coming down here with rent money, mortgage money, I need this to hit money, leave now. Because this is the part of the market where you can lose everything in one candle and the chart won't even apologize. Now, XXX. XXX isn't some fairy tale investor. XXX has a sickness, a profitable sickness. The trench pulls him back like gravity, and not every play is a win. What makes him dangerous is not perfection, it's discipline. He knows when he's got enough, and he knows when to walk away. And that's the difference between a trench trader and a trench victim. Now let me show you how he actually plays, because this is the part that keeps you alive. He doesn't jump in like a hero. He starts small, not because he's scared, because he's smart. He uses the first buy like a probe, a test, a rug check. He throws a tiny position in to answer one question. Does this thing move like a real market or like a trap? He watches. Does liquidity hold? Does volume look real or fake? Are buys consistent or is it just tiny retail spam? Are big sells appearing the second it pumps? Is one wallet controlling the whole chart? Because the trench has a rule. The first job is not to make money. The first job is to not get robbed. So he starts small, tests the water, and if it's clean, then he starts injecting size. Slow, controlled, never emotional. He adds only when the trade proves itself. Structure holds, liquidity stays thick enough, and the chart isn't just a spike and die. And if it fails that first probe, he takes the tiny loss and walks. No ego, no revenge, no it'll come back. Because that's how the trench eats people. No tools. Because if you're doing this without tools, you're basically blindfolded in traffic. At minimum, Axiom for execution and speed. Deck Screener for charts, liquidity, and volume truth. And the checklist every single time. Check liquidity first. Check volume second. Check holder concentration and recent sells. Check if it's one wallet propping it up. Check if price action is healthy or just manipulation. Then you decide. Is this a real money play or is this casino noise dressed up as alpha? And one more thing, the rule that keeps XXX alive. He never uses more than he can afford to lose because he assumes the truth. Most trench plays will lose. So he sizes like a professional, takes profits fast, and when he's up, he pays himself and walks away. Because the trench doesn't kill you on the first trade. It kills you after the win, when you feel invincible, when you size up, when you stop rug checking. That's when it takes everything back. All right, now that you understand how XXX plays it, all right, Garage Gang, I'm going to read you Lulu's tape exactly how she wrote it. Lulu's been off for a few days showing the new herd member around. So she didn't take any plays today, didn't get her hoof wet, but she did pull the charts, and she left us a clean battlefield map. Bitcoin first. Bitcoin is a range with a trapdoor underneath it. Resistance is up top around 88,175 to 88,293. If Bitcoin pushes into that zone and rejects, that's the market telling you it's still selling rallies. If Bitcoin breaks above 88,293 and holds it, the next upside magnet is around 89,175. And after that, the stretch target is around 89,702.68. Now the downside. Support is around 88,064 down to 88,028. If we lose that shelf, the next line is 87,950. And if 87,950 breaks and we can't reclaim it fast, that's when the trapdoor opens into the mid 87,000s. And the flush can get ugly quick because liquidity is thin. So the call on Bitcoin is simple. Bitcoin is neutral until it proves the break. But if support fails, it can fall fast. Now Ethereum. Ethereum is compressing, coiling under a ceiling. Resistance is the cluster around 2,988 to 2,993. If ETH clears that zone and holds, the next upside level is around 3,030, and the next stretch is around 3,069.1. Support is around 2,973, then a deeper shelf near 2,963. If ETH loses 2,963 and can't reclaim it quickly, that's where the chart turns bearish and the slide opens up. So ETH is a coil. Above resistance, it pops. Below support, it slides. Now Solana. Solana is sideways, but it has a clean trigger. The ceiling is around 127.89, then 128.88. If Sol breaks above 128.88 and holds, that's bull continuation. Next upside target is around 129.46, and then the low 131s if momentum stays alive. Support is the band around 125.83 down to 125.24. If Sol loses 125.24, the next slippery zone is the 124s, then the 123s. And the bigger downside magnet is around 120.69. So Sol is simple. Break the ceiling, we run. Lose the floor, we flush. No Cardano, ADA is still heavy. Resistance is around 37 to 38 cents. If ADA can't reclaim 38 cents and hold it, that's still a sell to rip structure. Support is around 37 cents. If ADA loses 37 cents clean, it opens toward the mid 36 cent area. And if the market rolls and ADA stays weak, the deeper downside magnet is around 31 cents. So the call is, until ADA holds above 38 cents, it's still bearish. And Lulu's final line is the one you need to tattoo on your forehead in a market like this. This is a levels market, not a beliefs market. Hold support, we stabilize. Lose support, we flush. Break resistance, we run. Garage gang, that's the map. Bitcoin in a box. ETH coiled under a ceiling. SOL sideways with a trigger. ADA heavy until it reclaims those sense levels. So tonight, don't trade hope. Trade levels. Trade confirmation. Trade discipline. Smash the like, hit the follow, share it with your favorite degen, especially the guy who turns into a trading coach after his third fireball. And by the way, none of this is financial advice. Just in case somehow you missed it, Lulu is a pig. And yes, she is the head of TA in the garage. Engines hot, safety off.